Welcome to Game Plan for Retirement with Chris Mcintire. Mcintire Retirement Services, Northwest Ohio's retirement planning resource.
And welcome into the program. This is your Game Plan for Retirement with Northwestern Ohio's resource for a common sense approach to planning, helping us face the complexities with our money, navigating this market environment, and planning for a more secure and confident financial and retirement future. He is president and founder of Mcintire Retirement Services. Chris Mcintire here with us, ladies and gentlemen. And Chris, we always appreciate the time and the insight and guidance.
Hey, Peter, good to be with everybody. Hope you're having a good weekend.
We appreciate you sharing your perspective and the education that you provide here on the program, Chris. Do want to remind you, ladies and gentlemen, before we get going, if you have questions of your own, if you have concerns about your money, your investments, your retirement accounts, and your plan for your financial future, working to help you achieve your goals, pick up the phone and give Chris Mcintire a call. The real value of the program is that you can take it that next step and you can get an individual, customized plan for your future put together with an experienced, qualified professional. Your game plan for retirement. All you need to do to get that process started, give Chris Mcintire and Mcintire Retirement Services a call, 800-868-1194. That is 800-868-1194. 800-868-1194. Chris, savers and investors noticing the market volatility, understandably worried. What is your take on everything that we are seeing with the market and the losses that many of us have experienced?
Yeah, it's been a tough year, no question about it. Stocks and bonds, certain commodities have fared pretty well. The commercial real estate market has been probably one of the bright spots. September is always one of the more volatile months anyway, so we expect volatility here regardless of the economic conditions, actually. If you look out throughout history, September is normally a negative month for the stock market. So whatever ends up happening in the next week or so isn't that big of a shock here to the system. And then we almost get like a reset going into the, call it the fourth quarter into, the holiday season and all that, when traditionally people start feeling better, spending more, maybe companies' earnings are better than what they had anticipated. Now, I think everything this year is kind of, up in play right now, big election up and coming, inflation, the word of the year for sure, has certainly thrown everything into the mix, right? They're raising interest rates, which is cooling the housing market. You're starting to hear of companies doing layoffs, so it's just one of those years that, everything's been beaten up. A lot of articles out there in the media about the 60-40 portfolio, 60% stocks, 40% bonds, having one of its worst years in history. And, that hopefully that gets better once they get the interest rate increases from slowing down and those bond prices can recover. Because again, the bond market's a little different. If you're holding on to your bonds, then what do you care what the price of it is? Because it's going to mature and you get your money back. For those that are, a little more actively trading their portfolio around, that wouldn't necessarily be the case.
Yeah. Well, Chris, inflation rampant, the Fed's response, hiking interest rates, 5 hikes so far this year, not an insignificant impact on the economy on either front. Holiday spending is expected to be a little lower as families have tightened their belts. The housing market has slowed significantly. I think I saw more than a 20% drop in year-over-year home sales, although the prices on homes that have sold have not decreased that significantly. So that's a little bit of good news. But putting perspective on the market and on the economy, this is kind of what we expected to see. In fact, you were talking about it into fourth quarter of last year as the Fed was kind of announcing and forecasting their intentions for this year, saying that, hey guys, as interest rates rise, the market tends to react in a negative way. And that's essentially what we've seen so far this year.
Yeah, no question about it. And, we've got even the international markets, energy is a big issue this year as well, Peter. So we're certainly, not surprised at it. And, you try to take your defensive measures and go into, higher quality type dividend paying stocks, kind of that lower volatility measure, if you will. utility companies and that type of thing have been popular sector. The energy market obviously has been very good for this year. So, unlike 2018, when they were going through some interest rate increases and stocks, bonds, and commodities were down, this year there are some bright spots in the marketplace that people can take advantage of. And, it may just be cushioning the loss, and that's okay. If the market's down 15 to 20% and you're down 6 to 7, that's, you're winning the battle, and hopefully you end up winning the war as well.
So keep things in perspective, in other words.
Yeah, exactly. And, the markets don't always go up, over the course of time. If you're reinvesting your dividends, you're buying more stocks at lower prices on these dips. If you're still working, put that money into the market. I mean, wouldn't you like to be able to buy into the market when it's down 20 to 30%? So it's been a good buying opportunity. Those folks just won't see those returns until we kind of, work our way out of this part of the economic cycle. And I talk with my hands. So for those of you watching this on a podcast, you'll see my graphics there with my hands there.
Well, we'll talk a little bit about our stage in life and how our portfolio positions should reflect that in a little bit in the program, Chris. But hindsight 2020, or as the great Carolina Panthers quarterback Cam Newton said repeatedly, hindsight's 50-50. Looking back, we can always see when we've turned the corner, but it's kind of hard to know in the moment when we have seen kind of the bottoming of the market and things beginning to return and rebound back to normal. Are there any indicators that you look for, or what should we be looking for as signs or signals of stability in this market?
Yeah, well, one thing that we do look for, Peter, is like in the month of July, we had a very good bounce off of the bottom. And for those of you sitting in cash, you might have missed a 7 to 10% bounce. August gave some of that back, and September's yet to be seen. Still got a little bit of time yet to go here to see how we end up for the month. But typically you'll start seeing, stock inflow. So obviously we probably read and do more research than the average listener out there. Is, when the inflows start working their way back in, and you'll start to see that. And you watch the moving averages of the stock market. Is it below its 200-day moving average, or is it starting to turn the corner? Some of those are some pretty big signals where, large investors start to come back into the market as well with bigger dollar amounts. And that can lead to, what we would like to think would be a long-term rally.
Chris, financial risk has been talked about and defined as the possibility of variables outside of our control affecting our financial outcome. And the market, one of those biggest risks that I think are part and parcel and just an accepted measure of risk that we are told to take financially. And yet we get uneasy when we see that risk come to fruition. Are investors really aware of what risk means to them and how much risk they are truly exposed to?
I would like to think our clients have a good feel for it because we talk about it quite often, but, to be generically speaking on the public airways, they probably do not. Most of the folks that are working out here today have a lot of their money in a retirement lifestyle fund that traditionally is going to work its way more into the fixed income or the bond market side of things as they get older, or as the calendar turns turns into another month. And that might not always be a good thing because, do you want to go work your way higher into, what could be longer duration bonds, in a rising interest rate environment? And we all know how that's been working out so far this year. So, a lot of times they do not. They think that by having a significant bond portfolio, they're cushioning some of the downside risk of stocks. That's a normal normal reaction or normal train of thought to have. In a lot of cases, that's correct. Okay. Except when you get a rising interest rate environment like we've got here. And, so you do have to adapt to the current economic changes, irrespective of what month is it on the calendar.
So not that this is unprecedented, but this is not typically what we experience in regular business and market cycles, Chris, I think is what I'm hearing.
Yeah, correct. Because we would want more cushion from owning bonds in a portfolio when stocks fall. Typically government bonds are going to go up in value. That has not been the case this year. And you had been asking previously what signals we look for. And, a lot of those signals come out of the government bond market. Right now you can, for most of 2022, you could make more money in a 2-year bond than you could a 10-year bond, right? The yield was higher. So we call that the yield inversion. And typically you would want to make more money in a longer term bond because you have more risk. More things can happen in a long time than in a 2-year window, for example. And a lot of that is those signals, that bond inversion, when a 2-year bond pays more interest than a 10-year bond, or the yield, that's a signal of a recession. So once we got on the other side of that, that would be one of those signals when the yield inverts to a normal pattern. Yeah, I don't know if revert's the word I'm looking for.
but the inversion is atypical and one of those signs and signals that economists often use and note that can be a foreshadowing kind of event for potential market turbulence and difficulty.
That is correct.
Talking with Chris Mcintire, ladies and gentlemen. If you've got questions, if you would like to schedule a time for a complimentary review of your financial investment and retirement portfolio, if you would like that in-depth strategy session and to formulate or double check your game plan for retirement, pick up the phone and give a call. 800-868-1194. That's 800-868-1194. Chris, you noted time keeps on ticking and our risk tolerance and exposure generally changes over time as well. Are there any good rules of thumb that you can give us kind of an overview of what that looks like, what that means to the average investor for our risk level over time and over the course of our financial progress?
Sure. There's kind of a foundation toward financial planning or retirement planning, if you will. It's called the rule of 100, Peter. And so you would typically take your age subtracted from 100. So again, let's just use that 60-year-old that's listening to the show today. Then again, one of the rules of thumb is how do you set up a portfolio there is take 100 minus 60, 40% in stocks, 60% in equities. Things that can offset that, would be how good of a pension do they have? How much Social Security income is coming in? Then you can modify that. But that's kind of, you have to start someplace. You could also say that, well, everybody in his family lived to be 105 and everybody on his wife's side lived to be 98. So there you might want to skew that a little bit too and take into longevity where you might use a little more stock exposure there too. So here's the main topic, and then the subtopics would be offset by pension, longevity, a couple other factors too.
A starting point, but in no way a hard and fast law. We've got to take our own individual set of circumstances into account there. But Chris, there are also some specific measures that you take with your clients to help them evaluate their risk tolerance. And this is kind of a buzzword that we've probably heard in the financial world, risk tolerance. What does this really mean, drilling down to trying to arrive at a conclusion for what our specific individual risk tolerance really is?
Sure. I think here in 2022, people's risk tolerance probably got the reality check that maybe it needed, right? We've had one heck of a bull market here for most individuals, from 2009 to 2020, and depends how your reactions were through the pandemic. And then here in 2022, some very harsh realities that have hit a lot of people, and maybe they realize, they were overexposed to stocks, overexposed to bonds. We like to drill down and explain, look, what will this portfolio do, in a 2008 crisis, in a coronavirus, in a World War II type setting, and you can run portfolios through some of those stress tests. And then, how do you offset that? What are the other risk mitigators to some of those things? We have a lot of clients that, have safe money strategies and they're not down anything for the year on that safe money strategy. They may not have made anything, but again, sometimes you do win by not losing. And, we use a lot of those types of strategies for our clients as well. And, we've been using, there's a particular fund that we like that deals a lot with commercial real estate, apartment buildings and things like that. That has also been a diversifier from just stocks and bonds. So looking at, the annuity space, the index annuity space is typically what we like to look at for a safe money strategy. Fixed annuities paying some very competitive rates right now, competitive to like a CD or a savings account, if you will. And then also some of that real estate, different types of holdings in there and commodities.
So risk tolerance and risk exposure, not necessarily connected the way that they should be, or that we sometimes think they are, but we can control our risk exposure, Chris, is what it sounds like you're saying.
Yeah, you certainly can. And, there are ways you can make some moves even after the market has sold off here to be able to participate in the growth of it, but none of the further decline. And, no strategy are perfect. That's why you build these nice diversified portfolios with a number of different elements to them. And, you have to make sure that you're creating enough income for today's retirees that may not have pensions. So even as the markets are declining, our dividend stocks paying enough dividends to satisfy the income. And again, not everybody's got a risk tolerance for 100% stock portfolio. And not, no question about that. We would certainly agree with that. Some of the bond yields will start coming back as they've been raising interest rates. So for those that are retired now, that picture can start looking a little bit brighter once we get inflation down, that the new bonds that are coming out at higher interest rates than some of the previous ones that we've been used to using. So, and we go back to that 4% rule. You were talking rules of thumb there before, Peter, and a lot of folks said, well, I've got $1 million and I can pull 4% off of that, according to all the magazines I've been reading, for the last 15 years, for example, or even longer than that. But, when the interest rates were cratering, bond yields were not supporting that part of that 4% adjusted for inflation withdrawal that so many people need to accomplish in their retirement.
Well, again, we need to make sure that our risk tolerance and our risk exposure are aligned in order to have the kind of progress and reasonable expectations for that progress that are appropriate for our situation. And that's an exercise that a lot of people have not gone through or fully understand, is not only their own individual specific risk tolerance, but maybe more important, how their portfolio specifically aligns with it. What is your risk exposure during great bull market runs, Chris, like we've seen over the past 14 years, a historic bull market run? We were all comfortable with a little higher risk exposure, but during a downturn, periods of volatility and market declines, we become uncomfortable many times with that risk exposure. Again, ladies and gentlemen, important that those things align within your portfolio, and then that it is proactively being monitored and maintained with an experienced, qualified professional advisor in that relationship. That is the role that they take on for you. That is the value of a advisor-client relationship. And if you would like to make sure that your portfolio does align with your risk tolerance, that's one of the steps in the complementary services that Chris Mcintire offers as an extension of this radio program. To take advantage of that, just pick up the phone and give a call, 800-868-1194. That's 800-868-1194. Chris, when you are conducting that risk tolerance survey and census, and then the analysis of the portfolio, are you finding that most not yet clients that come into your office to talk to you, savers and investors that are wondering about this, do you find that those portfolios and the risk tolerance is in alignment, or do you find more often that it is out of alignment? And what does that indicate to you?
Yeah, a lot of times they're very far out of alignment. We may have somebody who is, putting money in blindly in the 401k and invested for growth. And, then they retire and they come see us and, we do an analysis and said, you got 80% of your money in stocks here. You're retired, How do you feel about a 25% correction in the stock market on 80% of your portfolio? Here's what that dollar amount is. And, a lot of people are okay with a 10% correction, but they don't want to lose $100,000. But if you've got $1 million and the market falls 10%, that's 100,000. So, perception and reality sometimes are two different things. And it depends where the market's at in its particular cycle. Some folks will say, look, I just want to hang on for a little bit more. And then they, certainly they might get that little bit more and make some adjustments, or they might suffer and then say, well, now I can't do anything about it, and ride it all the way down to the bottom again. So, trying to help folks understand to say, look, yep, 2022 has been a rough year. You basically gave back what you made in 2021, so when you put it into a perspective like that, it's probably not, as bad as what a lot of people perceive it to be, but they have a mentality of, here's where my account was last month, here's where it is this month. And, instead of looking at it over the course of time. So part of our process, I guess, Peter, is as we understand the risk and everything is, what does this mean to you? What impact would that have on your lifestyle? Because think about it. If you've just retired in 2022, we've had a bear market where we're down more than 20% in stocks, and bonds are down, 10 to 15%. Man, that's a gut check, because you worked your entire life and all of a sudden here you just gave back 20% of the portfolio in a year. That's emotional. No question about it, buddy.
Yeah. And putting it further in perspective, it has been a rough year, Chris. At times, the Dow was down more than 15, the S&P down more than 20, the NASDAQ down near 30, entering into bear market territory, the definition of recession being debated. But yet still, we remain well above where previous bull markets peaked at, like the height of previous optimal times in the market. That cannot be said for many previous downturns. A lot of times when we have had significant market corrections in the past, we've lost more value and gone back down below where previous highs had been. So relatively speaking, we are still in fairly high territory as far as the market goes. And yet bear markets are not a infrequent or uncommon phenomenon. We are sort of taught and trained that, just take some risk in the market, will always go up over time. And yes, it has appreciated over time, but it's not been without some of these economic challenges and bear markets, some of them for more prolonged periods of time.
Yeah, no question about it. You normally want to expect about 18 months of an average bear market from the peak to the trough, and, I guess you could say, hey, we're probably coming up on a year here. As we got into the holiday season last year, the markets gave back a fair amount. And look at what has happened since. So, are we anywhere near the bottom? Time will tell. We've got the issues in the international side between Russia and Ukraine and what that's doing to the energy markets in Europe, which is driving prices up. I read over the weekend that in the United Kingdom, their inflation rate is 22%. So I would tell people out here, while we're listening to the show, we need a very diversified energy market. Electric vehicles are fine, gas vehicles, nuclear power, coal power, as we're going through this greening of the economy worldwide, we certainly need to do it in steps that aren't
sustainable.
That are sustainable. I got a cousin that lives in California said, all right, we don't have enough electricity to charge the electric vehicles that they're forcing us to buy. Think about that for a minute.
Yeah, you share oftentimes, Chris, some of the articles that you read and come across. What I got from that is that energy costs now 15% of GDP average across Europe. That is a large part of the total financial burden and costs and expenses that are going specifically toward energy. And so I agree with your sentiment there. We need to consider what those costs do to both, nationally, but us individually. Those costs are pretty exorbitant, and in line with, if not above, other costs, inflation that we are seeing. Another factor that has affected the economy. But Chris, again, talking about market volatility here, approach and expectations. And I know that there are different phases of our lifetime financially. And you were talking before the program about contributions or holding investments versus distributions, kind of three separate phases, and how our approach and our expectation moving through those three phases, or even with different accounts that we're doing different things with, needs to be addressed.
Sure. And I'll give you a couple of examples. As the market was going south here throughout the course of 2022, a number of clients sent emails, or we had conversations on the telephone about, what should they do with their 401k contributions? And, I made the suggestion. I'm like, well, here, let's think about this. You've got your 401k dollars that where the assets are positioned, the holdings, much more conservative. Your contributions right now, the market's down 20%. When would you want to buy? I want to buy when it's down. So, some of them we advise to shift into buying more stocks while the market's going down with contributions, but keeping the current holdings in their more conservative allocations. And once we get through this market cycle here, I'm sure we'll make some adjustments there on the stock bond ratio, but why not buy more when it's low than when it's high? That's what what would Warren do, right?
Yep. The Oracle of Omaha, and certainly a role model for many very savvy investors, what Warren does. But again, for retirement planning across Northwestern Ohio, Chris Mcintire is that resource, ladies and gentlemen. He has been a resource for many proactive planners to set up their plan, to execute on those plans, and continue to maintain and monitor those plans for a stable, confident retirement, worrying about living your life and taking care of those activities that you want to take care of, rather than constant concern about your money, your investments, and the market. If you would like to set up a time to speak with Chris to address your holdings, your accounts, your investments, your retirement, pick up the phone and give a call for that complimentary review, that retirement planning strategy session. 800-868-1194. That's 800-868-1194. 800-868-1194. Finally, on the program, Chris, what kind of investor are you? If we are a conservative investor, then we shouldn't have the expectations that we are beating the market. And likewise, if we are an aggressive investor and our mind frame is that we would like to match or beat the market, then we do need to be willing to accept the fact that that goes both ways. And if there's a downturn, we should have the expectation that we probably do see losses that are similar to, or in certain cases, even greater than the market. And yet that seems to be separate in a lot of people's minds. We've been taught our risk tolerance is all about the gains and the growth, not about the actual risk.
Yeah, Peter, a couple of good perspectives there. And let's think about it this way. If you're charting a conservative portfolio and an aggressive portfolio over the course of 20 years, you will certainly see times when they match one another. When the conservative portfolio is outperforming the aggressive portfolio, but we would certainly anticipate, over a 20-year period, the aggressive portfolio would would really outperform a conservative portfolio. When you start taking withdrawals out of these portfolios in retirement, there are some astounding, scenarios that we've seen presented at some of the events that Peter and I attend, conferences and whatnot. that shows more conservative portfolios hold up better with withdrawals than more aggressive all stock type portfolios built on growth versus built on income, if you will. Income would be dividends and interest from bonds. So it's a really interesting dynamic between, the conservative investor or the aggressive investor, in almost the turtle versus the hare, and who really ends up winning the race. And in some cases, it's very alarming to even the most aggressive investor when we show them some of these scenarios, because they'll say, I've never even looked at it that way, never even gave that any perspective. When withdrawals are coming out and you're an ultra aggressive investor, you have to make up so much more on the loss side of things because you're pulling out of money while you're dipping while you're losing value also.
Important for you to understand all of these factors and implications. And most investors do understand that there is risk involved with investing. And yet so many of us are uncomfortable with the possibility of taking losses, especially prolonged losses. And certainly during that period of time in retirement where we are living off of our assets. Chris Mcintire helps to set up plans that meet expectations for risk acceptance and volatility. More important now than ever. Pick up the phone to set up your game plan for retirement or have that risk review and analysis performed on your current investments and portfolio. 800-868-1194. That's 800-868-1194. 800-868-1194. And Chris, as always, we appreciate you being the resource to talk about these important factors in our financial progress.
Hey, happy to be with everybody. And remember to tune in here weekly, guys, because we're going to be talking about Roth conversions and some other things you can do to take advantage of these dips in the markets as we head toward the end of the year.
Visit McIntyreRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris Mcintire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Indexed or fixed annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charges as described in the annuity contract.